what about changing that payment? What would you suggest they do?
So they have the option to refinance. So let's say, another reason you want to keep track of your monthly payment and just be aware of what it is and what's going on with it is before you even face a situation where you're, getting late payments or not able to make your mortgage payment, you may want to consider refinancing it. All right. You can refinance into an adjustable mortgage that may help you to lower your payment. Mm-hmm. You can refinance, maybe set the term back a little bit longer. So if you're on a 20-year or 15-year and you find yourself maybe struggling a little bit to make the payment, you can reset it back to a 30-year, right? Extend the term, which will drop the payment down, which may make it a little bit easier to afford the mortgage payment.
Okay. Well, that sounds like a lot of options that a person maybe didn't think about. That's not necessarily facing difficulties, but just wants to lower the payment. So welcome back to the Mortgage Mindset Podcast with Kendall and Dekovan. Today, we're going to be talking about mortgage payments.
Mm-hmm.
So when it comes to mortgage payments, Dekovan, tell us a little bit about why that's important.
Well, so there's more to it than, some people think when it comes to the mortgage payment. When you break it down, there's a number of different things that go into your mortgage payment. So to, I guess, simplify it, the things that you have to know that go into a mortgage payment are going to be the principal, the interest, taxes, insurance, and then in some areas there's homeowner association dues. So all of those things go into the mortgage payment. So that's important because sometimes when you purchase a home, let's say a year later, 2 years later, sometimes the mortgage payment will change.
I think that's important because from like an investor standpoint, a lot of people, they have to know all of the things that go into it. A lot of times when they're just doing the simple math, maybe in a mortgage calculator, they don't realize just exactly how many different factors factor in. And that was an interesting one. HOA, I didn't think about that being something that would make your mortgage payment be higher than you may have anticipated.
Yeah, those are all things, at least the taxes, insurance, HOA dues are things that can fluctuate. So when you're calculating your payment, you may be thinking, okay, just principal and interest, but without including those other things, you won't come up with the full payment. And, whatever you calculate will be a lot shorter than what the actual mortgage company will come up with.
Okay. So now, just for those who perhaps are a little bit new to the terminology, when you say principal and interest, what do those two terms mean?
So the principal and interest is the money that actually goes to the lender or to the bank, right? So the principal is the amount that's going to be paid down toward whatever it is that you borrowed. And the interest is the money that the bank is going to make depending on the interest rate that you select or that you get whenever you're buying the house.
Okay. So that's really important because one changes based on the value of the price of the house, and then one changes based on the market.
Right.
And it's not something that sometimes we have much control over other than just deciding to go with you, and you can help them find the best rate. So
that's very true.
Okay. All right. So other than that, we do know that that there are other things that go into it. So you mentioned you have principal, you have interest. You also mentioned HOA, which we know is a homeowner association. Sometimes that'll be factored in. And then the other one that you mentioned was your taxes.
Mm-hmm.
So the taxes, that's a part of the payment that you make every month. So how does that work with the servicer of the loan? Is that something that they take all at once? Is that something they take every month, or how are those paid out?
So the taxes, here's another word, escrow. So whenever you escrow, that basically means that you're including your taxes and your insurance in the mortgage payment. So what the lender is going to do is get with the county, and they'll find out with the county records or tax records how much your taxes should be on that house for the year, and then they'll break that down monthly. And that monthly payment will be included in your total mortgage payment for the month. That way, whenever the end of the year comes, the mortgage company already has all of the money needed to go ahead and send that to the county to pay for your taxes, your property taxes.
Okay. So that's something that's calculated before closing.
Right.
So you will know that it's not going to fluctuate and change on you.
At least during that calendar year. So every year you get a tax bill, it's reassessed. They're looking at the tax rate, the value of your home, and they're coming up with how much you're going to have to pay for taxes for the year. And then your lender will actually get that tax certificate or the tax documentation to show, and then they'll break that down and include that in your mortgage payment.
Okay. And I think that that's really nice when you think about just the way the system works. A lot of times, one of the biggest things that gets us with different financial plays that people make is taxes. They make mistakes, don't understand fully, or get hit with a bill at the end of the year, and it's more than they really have the funds to cover. So it sounds like when you have a mortgage on your home, it's one of the benefits of buying with a mortgage or buying just all cash is that the mortgage servicer will take care of those taxes, calculating it, collecting it, and making sure that's paid on time.
Yeah, I mean, it's a really good thing for those that don't want to have to worry about doing a lump sum at the end of the year. Maybe they're not good at saving and making sure they have that money for when the end of the year comes. You can escrow it, and the mortgage company will take care of collecting that money and making the payment for you.
Okay. So now we've talked a little bit about the different things that go into a mortgage payment. But when it comes to actually making the mortgage payment, tell me a little bit about the benefits of making the mortgage payment on time. I know that that's really important. I mean, any bill should be paid on time, but why is it especially important when we talk about mortgages?
So mortgages is for most people going to be the biggest thing that they'll ever buy, right? You know, a house is going to cost you $250 and up. For the most part, you may be able to find something a little bit cheaper, but you know, especially in the Dallas market, DFW area, that's what the houses are going to be costing. So with that being the case, they weigh really heavily on your credit. So if you make a payment on your mortgage past 30 days, past the due date, it's going to have a major impact on your credit report because they're going to report it late. Now, there's a couple things you want to know whenever it comes to making your payment. So payments are due on the 1st. But you have a 15-day grace period. And during that 15-day grace period, between the 1st and the 15th, you can make your payment without having a late fee.
Gotcha.
So anytime you make it after the 15th, usually there's a 5% late fee that you'll have to pay. If you make it between, say, the 16th and the 30th, you'll have that 15-day late, 5% late payment. After that, then it's going to hit your credit. And that's where it'll have a major impact. Your credit.
So I would think that that's really important for individuals to know. So first of all, make it on time.
Right.
That's
it.
That is the answer.
Yeah.
So, but if you're unable to make it, let's say that the check, your employment check or something of that nature doesn't clear into the 2nd or 3rd or somewhere around there, then you do have time to make that payment.
Yeah.
Without it having a.
You got to be careful, right? Because it's easy to say, okay, I got these 15 days, and you forget, and you go past that, and now you got a late fee. And when you have that late fee, the next time your payment rolls around, you got to make sure you include the late fee
in the payment.
Okay, exactly.
Because then you would have made a partial payment.
Right.
Don't include your late fee.
Exactly.
Now, are there any benefits to, like, if you don't have it? I mean, like, what happens if somebody does make a partial payment? Is it still?
Well, as long as you make the full payment by the end of the month, then you're totally on track. But there's something that can help when you talk about partial payments, right? Let's say you're splitting up your payment. Some people choose to pay twice a month, right? Some people will choose to pay biweekly. Now, biweekly is a great thing because instead of making 12 payments or 24 payments, if you're paying twice a month, you end up making, if you're doing it biweekly, you'll make 26 payments. Yeah, so that'll help you to pay down your interest faster because you're making those additional payments toward the mortgage. You pay down the interest, you pay down the principal too, faster in order to be able to pay it off completely.
Okay, so that's really good to know because I think a lot of times people want to get ahead of things. So what's the right way to get ahead? Let's kind of talk about maybe the wrong way to get ahead. So can I just write 2 checks and put it in on the 1st and say, okay, so this is for this month and next month, and they'll figure that out?
So you don't want to leave it up to chance, right? Or for them to guess at what you're trying to do. So you want to specify, if you're writing checks, like how much is going toward the principal. If you're making an extra payment, you want that money to go toward the principal instead of paying toward interest. Because that's the money that you owe, right? You're not just trying to give the bank free money. So you want to indicate if you're making an online payment, usually there's a grid and you have to fill out the grid, and you'll want to say, all of this money that I'm paying, I want this to go toward the principal. So if there is no guessing, everybody's on the same page. They understand fully what you're paying that money for. Otherwise, the bank is going to take it as free money for themselves.
And they'll put it toward the interest.
Exactly.
Okay. And the interest is recalculated on what kind of schedule?
So there's an amortization schedule that you can get. Usually whenever you buy a home, they'll give you the schedule as part of your closing packet. And if you're doing a 30-year loan, it will show all 360 payments, right? So you can see the whole breakdown on the schedule. If you're paying extra, you're skipping some of those interest payments because you're paying it down faster. And you can see how much interest you're going to cut out. Okay. And how much faster you can pay off your house if you're able to make those additional payments.
Okay, so if someone has the ability to make additional payments, they should probably make additional payment.
Yeah, I mean, it's never a bad thing, right? Especially if you have the right mindset when you're thinking about your house, because it can be almost like a savings account for you, right? You can look at it like a retirement account too. So if you're making those additional payments, you're cutting out the interest, you're not paying money to the bank, and then that's just stacking toward the money that you have saved in the equity of your home.
And this is something I think that we're talking about now that makes a lot more sense than it did before, because as interest rates at this point in time are a little high. We're still in the early part of 2023. They're higher than most people have seen. So a lot of times folks would pay just the bare minimum because they only had 3% or under in interest that they were putting toward that. They could make more money somewhere else in a simple CD, which is they could just put it at the same bank and make more money than they were making on servicing their debt. But now with interest rates a little bit higher, depending on your income potential or your investing acumen, perhaps this is the best place to save your money, is to pay down interest so you don't have sometimes 7, 8, 9, 10% interest eating away at the value of your future money.
I think the average rate right now is like in the 6s, and depending on what company you go with, you may even see 7% up to 7.5%. So yeah, it's a huge thing to be able to cut that interest down so you don't have to worry about paying toward the interest going to the bank. More of your money is going toward what you're actually trying to purchase, which is your house.
Okay. So a lot of times when individuals who are looking at it from, let's say, a investment standpoint, like cash flow, they would feel like this is a difficult time to get into the market because they couldn't make that cash on cash return every month starting from the beginning. But if this is your primary residence, or if this is your forever home, or if this is a situation where you're just trying to build equity in this particular market, then it might make sense for a person to try to pay down their mortgage at a faster rate, because it would eliminate the interest that they would have to pay over time, and it would help build them equity a lot faster.
Yeah, definitely.
And own the home free and clear faster.
Right. Yeah, definitely. That's right.
Okay. So now we have the benefits of making extra payments. What are some of the other things that that come into play when a person is making late payments, and let's say it's not just a one-off. Let's say a person has kind of gotten into a bind. What are some of the damages that are going to come with that? And then what are some ways that somebody could possibly avoid that?
Yeah. So, I mean, major damages are going to be to your credit. Right? It's going to have a heavy hit on your credit. You'll notice it in your score. The other thing is, depending on how far you are behind, you're going to start getting in an area where you're facing foreclosure. The bank is going to look to take the house back. So a couple of things that you could do. First, you want to have a conversation with the servicer, with the bank, to try to get that back on track, see where you stand. Sometimes you can do a modification to help kind of reorganize the mortgage. Sometimes they'll put those late or payments that you owe on the back of it, which will help you to get back on track so that you can make that payment. And if you truly are just having a hard time, you may want to look to, if it's really, really necessary, to look into options to actually sell the home. That way it gives you a reset, even if you have to maybe rent a place for a little while, kind of get things back in order, so that you can get into a home that you truly can afford and you don't have to worry about constantly being behind.
Okay. So I'm hearing a few things as far as options that a person could have. So some of our listeners may really find themselves in a situation where either on their primary residence, they just don't have the income to make it happen, or they've overextended themselves in multiple investments and they're in a situation. So step one is to really contact the entity servicing your loan. So sometimes that's the bank, right?
Right. I mean, you don't want to bury your head and just be like, I'll just act like this isn't happening.
Yeah,
You're getting those letters in the mail. Yeah. It's just not the best way to go. You have options. So you got to really lay out the options and see which option is going to be the best for you.
So that's always step one, is to face the situation. Don't ignore it. Don't wait. Well, they can come take it from me. Don't have that attitude.
Right.
Because the reality is that under the mortgage arrangement, they own the house and you're paying it off over time. And so it's their home. It belongs to them. So service the debt. Pay your debts.
Number one. Right.
Number one. But if you're unable to, because, look at what just happened. Over the past few years, we're sort of, looks like we're headed toward the clear, but another situation like what took place in 2019 and this time, could hit us at any moment, where things just turn upside down. And so if that happens, or if you're in an industry that's been hit by just changes in the economy, then the reality is you may not be able to pay what you owe at this point in time. But if you talk to them, it sounds like there's options where a person can say, well, let's reset, and you start paying again.
Right.
And then all of the stuff you owe, we'll just add it to the debt that you owe us, and it won't become just this ballooning problem. So that's one option, is they can just sort of reset with you and help you to be able to make the payment. Now, selling, it does seem like it would alleviate some of the problems, but for some folks, the problem is the amount that they owe on the house versus the value of the house. So are there any options for somebody to get out from under a mortgage a little bit quicker if they have that situation?
Well, okay, so there's a few things, right? When you think about selling, we are at an all-time high when it comes to equity, right? So before we assume that we don't have the equity in the home, you want to have someone to actually pull the value for you. So you can reach out to a real estate agent, and they'll be able to do an analysis on your home and let you know what the prices are going for in your area. So that's one thing. You can also reach out to the bank and talk about a short sale. Okay. So that's another option where the bank may be willing to allow you to sell the home for less than what you owe on it. So banks are, they're savvy. They understand like what the value of the home is. They know that if it goes into foreclosure, they're going to have to take a hit, right? There's going to be litigation. You got to go through attorneys and all these things. So it may be worthwhile for them to do a short sale, to sell it for less than what you owe on it. Now, the negative or the downfall to the short sale is it is going to have an impact on your credit still. Right? So the late payments have an impact on your credit. The short sale will also have an impact on your credit, but it allows you to get from under the mortgage so you don't have that constant stress of those payments rolling around every 30 days and not being able to make them.
Okay. So we talked a lot about the different things that a person could face, just situations that will cause it to be difficult. But let's back up and say, how do we get ahead of that? So if we're talking to a homeowner, maybe a new homeowner who's never dealt with the mortgage system, never dealt with the banking system at this level, could they do something like set up automatic payments?
They could, yeah. So for some people, they just have a really, really busy work schedule, right? Or maybe it's just a person that's kind of forgetful. They just don't remember. So to help you out, you can go in and with the servicer and set it up so where it just automatically comes out of your bank account every month. You set it, you don't have to touch it again. We do recommend keeping track of it because we talked about the taxes and the insurance and things like that adjusting, right? So every year you get a tax statement that will come out. Your insurance may go up, those things change. So you want to keep track of it still, but you can set it up to where it automatically comes out of your bank account.
Okay. So that's really important. I think a lot of people can get ahead of some of the problems that they might have by just setting aside a certain amount, maybe a few months ahead, and not necessarily paying ahead, but setting up your own escrow account, just a little bank account that the bank can automatically, or the servicer can automatically pull the funds from every month. And just making sure, as you mentioned, to check it periodically to make sure that some of the amounts that they're taking haven't gone up due to taxes.
Right. Tax adjusting, insurance change.
Or let's say they had an adjustable rate mortgage and the rate adjusts.
That can happen too.
Okay.
That's another thing. Plus the HOA dues can change. So those things, different things can happen. I had a condo one time and we had to do some work to the exterior of it, which, caused the homeowner association dues to adjust and go up. So.
Yeah. And that would affect your mortgage payment. So if it was all automatic, it's something that you need to know so that you had enough funds in there.
Right.
Okay. Good to know. So now, Dekovan, realistically, we've talked about a lot of different things that play into the payment on the mortgage. But what about changing that payment? Let's say we get into a situation where the payment has become high, or we hear of others in the neighborhood who have lower payments. Or let's say somebody's with a bank or a servicer that they're not that satisfied with. What would you suggest they do?
So they have the option to refinance. So let's say, another reason you want to keep track of your monthly payment and just be aware of what it is and what's going on with it is before you even face a situation where you're, getting late payments or not able to make your mortgage payment, you may want to consider refinancing it. All right. You can refinance into an adjustable mortgage that may help you to lower your payment. You can refinance, maybe set the term back a little bit longer. So if you're on a 20-year or a 15-year and you find yourself, maybe struggling a little bit to make the payment, you can reset it back to a 30-year, right? Extend the term, which will drop the payment down, which may make it a little bit easier to afford the mortgage payment.
Okay. Well, that sounds like a lot of options that a person maybe didn't think about. That's not necessarily facing difficulties, but just wants to lower the payment. So you've got individuals who perhaps, your children are growing up, you're thinking about college and other things. So being able to lower your monthly payment so you can take that same amount and start to save it would be really maybe a good idea. Or you have individuals who perhaps are investing and they're looking at the rental rates changing or wanting to have more cash flow. And so being able to adjust their mortgage payment through a refinance might be something that would really work out for them. Yeah. And I guess that would be when they would call you.
Right. So exactly. Yeah. I would love to be able to help with that.
Okay. All right. Well, I think when we look at the key points from today, like the takeaways, we've got the fact that the mortgage is made up of the principal, the interest, taxes, insurance, and possibly HOA dues.
Right.
So it does have a lot of things that factor into the payment that you make every month. And so we want to make sure that we understand that and then we monitor it because it might change. Another thing that seems to be very important is the timing of the payments. Make your payments on time.
That's key.
And the schedule, remind us again, what are the dates that normally work out to be the best dates?
Oh, okay. Yeah. So your payment's due on the 1st. You have until the 15th, right? So between there is when you want to make your payment. That's a 15-day grace period. After that, it's typically a 5% late payment if you make it between the 16th and the end of the month. And then once those 30 days roll around, if you have not made a payment, that's when it's going to hit your credit.
Okay. So important to remember those dates. And the key is to just do it on the 1st. Now, if you are a forgetful person, automatic draw or automatic payment is something you can set up with your servicer, and it's highly recommended, especially for those of us who perhaps just are a little bit busier.
Yeah.
And don't have the time to write out checks. The world is changing. So get online, set it up.
Sure.
It's just easier. So those are some things that we can really take away. Of course, if you're struggling or if you look at the numbers and you think that you can negotiate a better payment, the best way to do that is to possibly refinance.
That's right.
That's one of the best ways. Because other things, you need insurance. While you can perhaps change insurance agents or insurance companies to adjust it by a little bit, if you really want to make a dent, then you'd want to talk to somebody like Dekovan and talk about what you have. What are your options when it comes to refinancing?
Exactly.
All right. Well, I think we better understand mortgage payments, what they are, what they're made of, how to make them, how to make them on time, how not to make them. So it's important.
Yep.
All right. I'm Kendall, and this is Dekovan for the Mortgage Mindset Podcast, where we're helping you get your mind right to get a mortgage.
Yeah. To invest and also purchase real estate.
All right.